Students, we have to discuss in advanced level in national accounts the way of calculating countries' GDP, gross domestic product. In that case, we can use production method, income method, and expenditure method to capture the value of GDP. So there is a systematic approach of each and every case, the way of assessing the value of GDP. So first of all, we just concern the way of calculating GDP under production method. In here, we do add all the sections in the industry. Agriculture, forestry, and fishing are three primary sector production. Then we look at value added. We do concern what is meant by value added later, as well as secondly, we add value added of industries, simply secondary sector production. Meanwhile, value added of services, tertiary sector output. When we add these three together, we will calculate gross value added. Actually, the term added here, value added, you see, value added sense the output of a firm when intermediate consumption is subtracted from the gross output. For example, fertilizer is an intermediate input, in other words, raw material for the agriculture production. Farmers have to use. Then agriculture farmers received a particular output. Then they assess the value of the output. It is called gross value output. Meanwhile, they used fertilizer. It is a output of another industry. So they use such a value, then it should be subtracted from the gross value output. If so, we will calculate gross value added. So gross value added is a genuine output or accurate value of the production. Likewise, we concern value added of these three sections. Then finally, we calculate gross value added at basic price. We do concern the basic price as well. The basic price means the price which is calculated at producer's level. In other words, all the taxes are ignored or reduced while subsidies are added at the basic price. Then we will have another price, market price. So market price is captured when taxes are added and subsidies are subtracted. You see, taxes less subsidies on products. If we add taxes less subsidies on products, we will calculate gross domestic product at market price. This is how we will identify, we will measure country's GDP at the production method. Here a question. The following details were extracted from a hypothetical economy. Gross value output of agriculture, forestry, and fishing. Intermediate consumption, agriculture, forestry, and fishing. Gross value output of industries. Intermediate consumption of industries. Gross value output of services. Intermediate consumption of services. Also, taxes less subsidies on products. Then what we are supposed to calculate here, gross value added, GVA, typically at basic price, and GDP at the market price. So basic price and the market price, such a difference depends upon taxes less subsidies. I mean, at the market price, all the taxes are included while subsidies are excluded. So basic price can be converted into market price by considering taxes less subsidies on product. So we will consider how to calculate gross value added. First of all, gross value added, of course, intermediate consumption is subtracted from gross value output. If so, we will calculate the genuine or accurate output of each and every section. It's like this. So gross value output IC minus GVO minus IC, then the answer should be gross value addition. Here, agriculture, forestry, fishing. There was number of facts, figures. Those are assumed values. Just I wanted to share the knowledge. 2,300 GVO, agriculture, forestry, and fishing. Intermediate consumption was at 300. Then the gross value output, say addition, gross value addition, 2,000. Industry is 4,600. Intermediate consumption is 600. Then gross value added, GVA 4,000. Services 6,900, 1,200, 5,700 is gross value addition. So gross value added at basic price. Basic price means before net taxes. Before net taxes. Net taxes sense taxes less subsidies. 11,700 if we add all these three. Thereafter, gross domestic product is measured when 11,700 is added to 400, then 12,100. Anyways, the method is gross GDP equal GVA plus net taxes. GVA plus net taxes. After discussing such a production method, we do consider income method as well. In here, production is exactly equal to factor owner's income. What are the factor income? What we studied in economics, rent, wages, interest, profit. These income are added together to calculate income. So economists found total GDP is exactly equal to the income. So then there is a technical background. In other words, SNA 2008 has introduced a particular framework or format of calculating GDP under income method. First of all, compensation of employees, simply wages. Or all wage equivalents, any kind of rewards are considered as compensation of employees. Secondly, gross operating surplus. This may include interest, rent, and gross profit. Okay, interest, rent, and gross profit. There are three facts here. Then net operating surplus, simply net profit. Businesses net profit, net operating surplus. Consumption of fixed capital. We know very well such a term in economic accounting, even depreciation. Consumption of fixed capital. You know, in accounting, such a value, annual depreciation, is subtracted from the gross profit. But there is no financial outflow. We considered as an expense. according to the accounting concepts, but it is wrong in here. Then what do we do? Once again, add such depreciations to the net profit. So net operating surplus plus fixed capital, in other words, consumption of fixed capital or depreciation. Then mixed income. Before the mixed income, we can add some more expense, some more income sources like rent, even interest. We can add under net operating surplus. I will add here like this way. Net profit plus interest plus rent. These are the income sources. Here in the first case, wage. So now wage is there, return on labor, profit, interest, rent. All the four factors are there, plus depreciation. We need gross profit, not the net profit. Depreciation should be added once again. We add it separately. Then SNA has introduced one more, SNA 2008, mixed income. This is called, we can say self-employment. Self-employment income. So variety of self-employment income are considered over there. Then we will add taxes less subsidies on production. This is very special situation, production. Earlier you came across taxes less subsidies on products. This is taxes less subsidies on production. When the production exists, for the production process, there are some taxes, not for goods and services. This is a tax for the production. You know, this may include a variety of charges, sometimes license or certificate, this and that. Meanwhile, government introduces subsidies, not directly for the product, training for workers, providing particular support from the government, support, not directly. Anyways, it is a subsidy from the product for the production. Then we can calculate gross value added at basic price when we add these four together. Taxes less subsidies on products. Earlier also we came to know products, now also products. Here, this is about taxes. It focuses tax for a product, even sort of a excise duty. Price is there, tax is there for the product wise. Subsidies also there product wise. Earlier, taxes and subsidies for the production, whole process. That is the difference. So finally, gross domestic product is calculated at market price. This should be changed. This should be market price. Right. So GDP at market price. Market price is found when net taxes are added to gross value addition. This is the income method of calculating countries' GDP. So after this, we do concentrate a particular exercise. The following data of a hypothetical economy have been given below. Items value, rupees in billion, employment income, rent, interest, undistributed profit, mixed income, fixed capital consumption, other taxes less subsidies, other taxes on production less subsidies, corporate income tax, net indirect taxes, as well as dividends. Number of data are given. We are supposed to calculate gross value added at basic price. What do we have to do now? Considering such a format: compensation of employees, gross operating surplus, mixed income, then taxes less subsidies on production. Then we calculate gross value added. After calculating gross value added, we can convert such a value into GDP by adding up net indirect taxes. So then compensation of employees 225, gross operating surplus, gross profit I added separately. So this is also important exam. We have to know what are the things, what kind of elements are there under gross profit. So corporate income tax, undistributed profit, dividend. All these four, including capital consumption, is said to be gross profit. This is the value, gross profit. Thereafter, rent and interest, another factor income, sometimes net interest. When particular charges, expenses also there, all the expenses are deducted from the interest income, then we look at net interest here. Then third one, mixed income. So non-production taxes less subsidies. 5. So then when we add all these together, gross operating surplus is 235, 225 is compensation of employees, simply wages. Also abbreviation is there, COE. It is possible. You can also use these abbreviations introduced by SNA 2008. So gross operating surplus, US, consumption of fixed capital, CFC, mixed income, MI, GVA, GDP. So when we add all these together, including mixed income and non-production taxes less subsidies, gross value added at basic price 545. This is called gross value added at basic price. Then we add taxes less subsidies on products as usual, 20. GVA can be converted to GDP by adding up net taxes. Then answer is 565. 565. So students make mistakes if they do not remember the format. These formats are compulsorily memorized. Otherwise, quite difficult when you face this kind of questions. Then last method, expenditure approach. In here, expenditure method concentrate the way of purchasing goods and services, the things what the economy has produced should be purchased by consumers or people in the society. So such an expenditure is exactly equal to the production produced in the economy. You see, therefore, total expenditure elements, adding up total expenditure elements are exactly similar to countries' GDP. That's what economists recognized here. So there is a particular technique or system of measuring expenditure approach. Final consumption expenditure. Final consumption expenditure. Gross domestic capital formation. Gross domestic expenditure at market price. Gross domestic expenditure at market price. Gross domestic product at market price. So earlier we came across GVA. Right now we don't have GVA. Instead of that, we have GDE, gross domestic expenditure. So the structure bit differs from previous structures. So many questions are, we can see examiners often concern expenditure method to what you call test your knowledge in the examination compared with production or income method. Actually, in the production method is nothing. There are no any further calculations, but in here expenditure method, there are some, even income method, there are very important analysis. Anyways, final consumption expenditure includes three components. What are those? Household consumption. You know, everyone in the society are said to be household. So they should consume. They spend money. It is called household consumption. Meanwhile, government should also spend. They have to spend money on education, military, I mean, defense, healthcare, and many more expenses are there. All the things are captured here. Non-profit institutions serving households. Actually, this is a new one added to SNA, simply our system. Earlier we didn't have such a category. This is also called NPISH, abbreviation, standard abbreviation, non-profit institutions serving household. This is sort of clubs, some organizations which will facilitate people, maybe trade unions or pressure groups, whatever. Their target is providing particular supports for people in the society. So all the expenses are captured here. Then final consumption expenditure include these three. Then gross capital formation, simply investment. This is also called investment, gross investment. It is another term. Sometimes this is called private, gross domestic private investment, also correct. Anyways, there are three. Gross domestic fixed capital formation. First of all, this is called investment done by private sector and public sector. Meanwhile, changes in stock, inventories, beginning of the period, beginning of the year, end of the year. We will subtract closing stock from the opening stock. So we will realize the change in the stock, how much has changed. So it is called gross domestic capital formation. It is not used for the consumption, but it is in the process. What are the stocks here? There are raw materials, semi-finished goods, finished goods. Raw materials, semi-finished goods. As well as finished goods. So raw materials, of course, the things what they have not used yet for the production, still available at their storage. But semi-finished goods, halfly done, not completed. Finished goods not sold, it is at the storage, need to sell. All these are changes in stocks. So then changes in value, even SNA 2008 introduced this one newly. Changes in valuable sense are things what we use for the purpose, day-to-day purposes, maybe gold, diamond. These are valuable things, even antiques. These are valuable, but this will be not used for the production, even not for the consumption. You may have a variety of valuable things, gold items, but it is as it is, not consumed, not involved in the production, just you keep as it is. So there is a change in value. Such changes in values of those items are captured here. Then it is under the gross domestic capital formation. Finally, we complete gross domestic expenditure when we add final consumption expenditure plus gross domestic capital formation. If we add these two together, we will calculate gross domestic expenditure at market price. It is 16,300. Thereafter, net export. Net export means exports minus imports. Exports minus imports. Right now, 700 minus 500, it is 200. Sometimes imports are greater than exports. In such a case, this becomes negative value. You see? So, GDP in such a case, lower than GDE. Lower than GDE. It is also a particular possible situation because we import a lot than the goods we exported to abroad. As a result, country's GDP is lower than gross domestic expenditure. Anyways, here it is a positive value. As a result, GDP means 16,300 plus 200, altogether 16,500. Here a question. Details are given in hypothetical economy, household consumption, government consumption in PISH, gross domestic fixed capital formation, changes in stock, changes in valuables, exports, imports. The things are given as usual, like in order. What we have to do, use the format. In the examination, we are supposed to calculate GDE separately, GDP separately, but don't forget, here we do not have GVA, gross value added. Anyways, we can convert GDP into GVA if we are given net taxes. What we have to do after calculating GDP, just we subtract net taxes. Then we will calculate GVA. So here the format of calculating countries' GDP under expenditure method: household consumption expenditure, government consumption expenditure, non-profit institutions serving households, altogether total consumption. Gross domestic capital formation, gross domestic fixed capital formation, investments, changes in stocks, changes in valuables, altogether 1,750. Gross domestic expenditure, GDE, we add these two together. Then GDE, net export should be added. Right now, imports are greater than export. As a result, it is subtracted. Then 9,530. See, you see, now GDP is lower than the GDE. It happens when there is a higher imports than exported goods. After this one, double counting and multiple counting error. So now, right now, we considered three approaches of calculating country's GDP. Now we have to consider, why do we want to calculate gross value added? Very beginning, I said we will look at GVA under the production method. Why is that? Because of double counting and multiple counting error. The example what I said before, fertilizer. Fertilizer is an output of a fertilizer company. Then it is used by a farmer as well. Then farmer determine the price of the output by considering the cost of fertilizer. When the output is transferred to the market, such a value includes the value of or the cost of subsidies, say transfers. I'm sorry, what you call the fertilizer. As a result, fertilizer, the value of fertilizer is carried by the output of agriculture. If total output of fertilizer company is considered for the production in the economy, then GDP includes value of fertilizer twice, because agriculture also includes, or the farmer considered cost of fertilizer to determine the price. It is already there. If the value of fertilizer company or the total output is considered, then it includes the things used by the agriculture farmer as well. Then GDP may include or the such a value of fertilizer twice. Overstated, it is wrong. Overstated, it's wrong. So it is called double counting error. In some cases, it may arise as many times, right? Many times. Fertilizer used for the agriculture, they are now restaurant took the such agriculture things to prepare meals. So they determine the price by considering the cost of agriculture. And agriculture includes the cost of fertilizer, then many times. So many multiple counting error. So such a problem should be eliminated. Otherwise, gross domestic product is not accurate. There are two approaches in this case. One is final product approach. Other one is value added approach. So first of all, this is where certain items are counted more than once, resulting in overestimation of national product to the extent of value of intermediate goods included. This is called problem of double counting or multiple counting error, which means counting value of same commodity more than once. Theoretically, there are two alternative ways of avoiding double counting error counting, namely final output approach and value added approach. So we can use either one. Either one means, in the previous example, fertilizer used by agriculture producers necessarily. Then government can consider, although we can say the people who are involved in estimating GDP survey, they are doing a survey, such a workforce, they can consider only for farmers' output. They can ignore output of fertilizer, right? For output of fertilizer, then such a problem is overcome. It is called final product approach. Then agriculture production only considered, not the fertilizer. Then the value, next one, value added. Value added is where fertilizer company output is taken. Agriculture producer had an output, imagine 10,000, but he used 1,000 worth fertilizer. Then 1,000 is deducted from 10,000. Then 9,000 is the genuine value of agriculture. Such a 9,000 is added. Then it is called value added method. Actually, value added method is the correct or accurate compared with final product approach. Why is that? In both cases, it can avoid this problem, but value added method is more accurate. Why is that? Under the value added method, we consider accurate value that each business generate. But final production method, no one knows which one is final output or which one is intermediate output. For example, sugar. Sugar is a final product for consumers. When they are making tea for the home purpose, they use as a final consumption. Cake manufacturers, sweet manufacturers, they use sugar as an intermediate. Then there's a problem. If sugar company output is eliminated, only sweet companies or else cake manufacturers output can be considered. In that case, real value or the accurate value of sugar is not counted. Why? Certain sugar or the things are consumed by consumers for their final consumption. It is a final output. In some cases, such a product becomes an intermediate good as well. Therefore, final product method is somewhat difficult. Quite difficult to decide which one is intermediate, which one is final. So then, value-added approach is best. It is one case sugar. When we come to fertilizer, even fertilizer is not used directly. It is obviously for the something else. But sugar can be used directly. You see, that's the problem. As a result, final production method is quite difficult. So here, but actual practice, double counting state occurs unintentionally in final product approach, because every producer treat the product he sells as a final product, though the same might have been used by the buyer as an intermediate product. Thus, this error is successfully avoided when value-added approach is applied to the measure of GDP. Then the expenditure method, before it eliminating double counting and multiple counting error under the production method and income method. Under the production method, already we understood the approach. GVO minus IC, intermediate consumption. In the previous example, what I said, agriculture farmers use fertilizer, 10,000 worth output, but 1,000 use as a fertilizer expenditure. Then remove 1,000 from 10,000, then it is 9,000 worth output. It is called value added. Likewise, here firm A sells to firm B. Imagine sugar company to sweet maker. Then sugar company had 800. There is no any value added. Therefore, 800 can be taken as it is. Sugar company, the sweet maker, to someone else. So such a format, such a flow, B to C. Then 1,400 is the output of the sugar company. Then 800, say sweet maker, 800 used as a raw material received from the sugar. So then 600 is value added. Then once again, C to D, 2,200 is the output of company. Like D, say they used from C 1,400. Then the value added of D, of course, 800. When we add all these together, it is 1,200. 1,200. No, it's wrong. 2,200. 2,000. The total becomes 2,200. 2,200. Why is that? How do we can judge here? 2,200 is the value added. At the same time, final output also the same, 2,200. That's why I told you we can use final output method or else value added. This is the final output. If we use final output, it can overcome double counting error. GVA 1,000, 2,200, same method, it can overcome. But we should not add all the things together, like production of 800, 1,400, 2,200. If we add all these together, like output of B, 800 plus output of C, 1400, then output of D, 2200. If so, value is overstated. Overstated 4400. It is completely wrong. 4400 overstated, then our national accounts are wrongly measured. Therefore, we have to use either final output method or value added. Then we emphasized value added is the best. Value added is the best. Then income method. Under the income method, we can measure country's GDP by considering. So the production method here we considered way of calculating, of avoiding double count, multiple count error. In here, we look at all the primary income sources added together. What are the primary income? Compensation of employees, gross operating surplus, mixed income, including taxes less subsidies on production. If we add all these 4 income sources, this is not an income actually, income source. If we add all of these together, we will add gross value added. So the country's production is exactly equal to a factor income of factor owners. That is the concept. Therefore, considering all the primary income, factor income helps to avoid such a double counting or multiple counting error. In here, we do not take any transfer income. Transfers are ignored. Transfer sense like unproductive events. Maybe farmers, people receive a particular transfer payment like Samruddhi from the government or any other benefit from the government. It is not a productive activity. It should be ignored. Then under the income method, all transfers are not considered. After this one, expenditure method. In here, double counting error is overcome when intermediate consumption expenditure are excluded. Simply, the things what they use for the production as an intermediate goods should be overcome. So final consumption expenditure only be considered over there. As well as transfer expenditure, transfers should be avoided. It is not productive event. It should be avoided when the production method is calculated. As well as different pricing methods are included here. SNA 2008 has emphasized clearly different pricing methods for the producer to purchaser. So there are 3 types. Basically, we understood already these 2: basic price and the purchaser's price. According to SNA 2008, there is a one more producer's price. This is actually flow. Imagine farmer is a agriculture producer. He expects particular amount from people who purchase output. It is called basic price. It is called basic price. Wholesalers purchase particular stuff from farmer. Then he has a process at his organization. Then wholesaler wise, then wholesaler may receive particular benefit from the government for the production, not for products. It is for the production. Even government collect taxes like penalties, sometimes a license, sometimes a business rate, variety of things from the producer. It is a taxes on production. So then finally, purchaser's price. There are taxes like VAT, as well as producers, consumers may have a particular charges, even consumer finally pay all the charges, all the profit margin, even taxes on imported goods, all the things are paid by final consumer. So likewise, prices are changed from farmer to ultimate consumer. Farmer received a particular amount, then the wholesaler received such output, then price is added, transportation cost is there, prices change, profit margin is there, then the retailer went to retail, then retail also added profit margin, finally it came to consumer's hand, then prices were changed. So ultimately consumer has to purchase. It is called purchaser's price, in other words market price. Actually GDP is calculated at purchaser's price or market price. So here the basic price, the amount receivable by the producer exclusive of taxes payable on products and inclusive subsidies. So taxes are not included, but subsidies are included for the production. Next one, producer's price. Producer's price is amount receivable by producer inclusive taxes of products. Products, of course, like VAT. Here actually there is a taxes on sort of production taxes there, except deductible VAT and exclusive subsidies on products. So producer's price, basic price, what is there? Here basic price plus taxes on products excluding VAT. Any other kind of taxes are added. Then purchaser's price. Purchaser's price is the amount of payable by purchaser. This include trade margins, wholesaler, retailer, definition the output, as well as transport margin, transport charges, as well as non-deductible VAT. Simply non-deductible means it is paid by the consumer alone. They are not producers. That's why non-deductible. Producers can deduct when they purchase some items, raw materials, there's a VAT. When they sell their products, such a VAT can be claimed. That's what non-deductible mean. But final consumers have no way to deduct such a VAT. Finally, purchaser's price, producer's price plus trade and transport margin, non-deductible VAT. All the things are included here. Simply, basic price to purchaser's price means all the taxes are included, all the subsidies are excluded, plus profit margin, transportation charges, taxes on imports, everything are included. These are three types of pricing methods. Then I added as a last GVA at basic price, GDP at market price, minus net taxes. Net taxes means taxes minus subsidies. That's what net taxes. Then GDP at market price means GVA at basic price plus net taxes. Taxes are added, subsidies are deducted on products. These are on products, not for the production. This is how we convert GVA into GDP or GDP into GVA. So two different prices, market price plus basic price as well. Right. That's it for the lesson.